All right, so the next step is to, now that we've done these four, is the tax rate. So this is one that you definitely did not look at in intro to accounting. And so it does involve another adjustment. Companies, as a tax issue, have to estimate their taxes quarterly. And they don't pay them necessarily, but they do need to estimate them. And so this is, in this case, we're kind of suspending that reality and saying, all right, they haven't estimated their taxes for an entire year. And the way that tax expense is calculated is by looking at all of the revenues and the expenses we've recorded to date, including the ones that came from adjusting entries. So we're going to use that information as well in our calculation. Sorry, I was looking for where I put that piece of paper. All right, so first things first, make sure you do not you don't forget to include any of the revenues or expenses that were recognized during the period. So we recognize sales revenue of 425,000 during the period. We recognized wage expense of 200,000 during the period. And since that's an expense, it's a deduction. Now, the dividends, this is not an income item. It is a temporary account. We will close it, but it is not an income item. So we do not worry about taxes when calculating. I'm sorry, we do not worry about dividends when calculating taxes. Now I want to bring over the entries I made during uh, that I've already made because we need to add to this depreciation expense that was recognized for 50,000. We want to bring in the insurance expense for 16,000. We want to recognize interest for 2,667. K. The K's work great when I'm just getting rid of zeros. They're a little bit sloppy when those are not zero digits. And then the deferred revenue. Okay, now be careful. Don't just go on like a tariff subtraction. We need to add that. That is additional sales revenue. So we need to add 20,000 here to that. Oops, sorry. See, and I almost did that. Exactly. I almost started putting parentheses around that, but we're adding that. Okay. So we take the sum of all these expenses and revenues. Um, and again, I'm switching over my calculator real quick just to make sure I got this right. Subtracting 200, subtracting 50, subtracting 16, subtracting 2.667, and then adding 20. So that number seems kind of familiar for this problem. I believe it is correct. I won't use the K this time. This is my pre-tax income. So we're only taxed on our profit, which is revenues less expenses. If there's any gains or losses in there, we put them in. Just like we do revenues and expenses, we add the gains, we subtract the losses. Cost of goods sold would be one of these as well. So we want to include absolutely every revenue, expense, gain, or loss. Notice we do not include deferred revenue because deferred revenue is not a revenue, it is a liability account. All right. So be careful. You can't just grab anything that says revenue or an expense. You got to make sure it's an income statement account. But that gives me my pre-tax income. Now I apply the tax rate of 40% to that. And Of course, I didn't save it on my calculator like a fool. 176,333 times 40% is 70,533 and some cents. And I'll just drop the cents. So round it to the nearest dollar. This is my tax expense. Now you could take it one step further using the pre-tax amount and the tax expense wasn't asked here, but we will see it again on closing entries. If we subtract the $70,533, we have 105,800. This, because this is pre-tax, this is tax expense, right? Since this is pre-tax income, then it's basically we're on the line of an income statement that says, okay, subtract this one more expense. This would be net income. So that's the net income of the company. Like I said, we don't need that for the adjustment, the 105,800, but we'll see where it comes out again when we do the closing process. So to record this tax expense of 70,533, we need one last adjusting entry, tax expense for 70,533. And tax expense is just accrued into taxes payable for the same amount. And tax expense is an income statement item. It goes on the income statement. Taxes payable is a liability account. It increases liabilities since we're crediting it. Um, and again, is this an accrual or a deferral? Well, in this case, it is an accrual because we are recognizing the expense prior to paying that amount. And so, since the expense or revenue is coming first and then the cash action is coming at a subsequent time, that's an accrual. So, big picture with the tax, make sure that you include both the unadjusted income statement and all of the adjustments that we've made to income statement accounts, but do not include dividends. And remember that we are only taxed on profit. We will not be taxed strictly on our revenue. All right, so that pretty much completes the adjusting process for this question. Now, the closing process. Um, as to me, if you can remember, the closing process is basically first calculating net income, and then second, calculating retained earnings. You shouldn't have to memorize, oh, I have to make these certain entries in this order, and it includes these things. Because if you can calculate net income, you know that you need to take revenues, add any gains, subtract any losses, subtract any expenses, and also, of course, subtract losses. Then you know that the first steps of the closing process have to deal with those accounts in some form or fashion. So in order to calculate net income and translate that over into journal entries, we use the income summary because really net income is just the result of closing to the income summary. And when I do the T account, it might make a little bit more sense. That pen is slowly dying, which is sad because that was one of my really good ones. All right. See, now I want to like put 5 lines over everything now, right? To darken it up. All right, this one might work. All right, so the first thing we're going to do is close any of our revenue accounts. And really, we had two revenues. We had the sales revenue that was unadjusted. We added additional revenue of 20,000. So in total, we had, of course, now this one doesn't want to work. Great. And then we go on to the next one. Just something that, oh, good Lord have mercy. This is like a pen cleaning moment for me, apparently. A lot of stuff to throw away. Oh gosh, I don't need it. Pause for a second. All right, I think we're ready now. So we got sales revenue of the 425 and the 20. So that's 445 in total. And notice, of course, I'm wanting to debit revenue in this case because if we think about the sales revenue account and we had an unadjusted balance of 425, we credited sales revenue in our journal entry to record the gift cards. So we add 20,000 more to that unadjusted balance. That would have given me a $445,000 adjusted balance. And now I'm debiting this account by 445 in order to make it zero. This will be my post-closing balance. So right now, what I'm recording is that entry that zeroes this account out. And what do I need to credit, right? I have a debit, I need to credit. Well, that credit's going to go to income summary. And you may or may not be familiar with this. Some texts have taken away the income summary account. I feel like it's a wholly important thing, even though we're just going to turn around and close it out. The income summary account, as I mentioned, is really just a place to tabulate net income, but it's helpful in understanding that certain items like expenses, revenues, gains, and losses will go through net income and affect retained earnings. But then there are other items that will not go through net income and still affect retained earnings, i.e., dividends. There are others in more advanced accounting, but dividends is the simple example. All right, now we closed revenues, we got them in our income summary. Now we just need to close expenses, and then we're going to add those to the income summary. And if you think through it, you're probably going to come up with the idea that, okay, well, when we get rid of those expenses, they're going to end up over on the debit side of the income summary, and that is correct. We want to close expenses with credits. So we have to close the wage expense. That was 200,000. We have to close depreciation expense. And that's 450 for 50,000. So that sounds like 450. We got to close our insurance expense, and that's 16. Interest expense, that's going to be 2,667. And And I want to close tax expense. Don't forget tax expense. Definitely something we need to close. That was for 70,533. All right. So now I want to find out what that total is so I know how much in total to close out to the income summary. So we have 266,000 between the first three. I'm going to add in the 2,667, and then we're going to add in the tax. And then when I add all that together, what I get is 339,200. Now, debited the income summary, so I need to debit over here on my T account to show the progress of this account so far. I have my revenues, all of my revenues. If I had gains, I'd close the gain out here with a debit. If I had losses, I'd close the loss out here with a credit. So the right side will represent all of my revenues and gains. The left side will represent all of my expenses and losses. And if I take the difference between the two, well, then I just come up with net income. And if you take this difference, it is indeed 105,800 because it includes the tax expense. So all our expenses have been netted from all of our revenues with this income summary. Now, as I said, the income summary is just essentially net income, right? It's just giving me what my income is at the end of this period. I need to turn around and close that as well. And that's why the books have decided to skip this step sometimes. Well, I need to close the income summary for $105,800. That is going to be a debit to my income summary account because it had a credit balance. So in order to zero it, I would need to debit it. And that zeroes out the account appropriately, which is what we wanted to do. The credit is to retained earnings. So now we've moved from our first procedure, which is to calculate net income. We did. Now we're calculating retained earnings, and we need to remember that retained earnings is always beginning retained earnings plus net income minus dividends. And that gives me where my ending retained earnings is. So what we're doing with this closing entry is essentially adding net income because we're debiting the income summary by 105,800, but then we're crediting retained earnings, which adds this amount into the retained earnings account. It's adding the net income in there. And then the final thing we need to do, well, and before I move on, this is probably the first place where a T account is so helpful because you can remember, in terms of closing entries, just remember, okay, I want to close the revenue account. I increase revenues by crediting them. So in order to close it, I have to debit them. Okay, so that gives me this here, right? Debit, sales revenue, credit, income summary. Same logic, just in reverse for expenses. I debit expenses to increase them. So I want to credit them here in order to zero them out, and I'll debit the income summary. Once I have the income summary, then it gives me a new balance. If if right, the income summary can have a debit balance, it can have a credit balance. It will have a debit balance when expenses and losses are greater than revenues and gains, right? So basically, it has a debit balance when we don't have net income, but we have a net loss. In this case, we had income positive, greater than zero, so it was a credit balance. But it can go either way. And so you don't know where to close it necessarily unless, or how to close it unless you have this T account, because it's not always going to be a debit to close it. If we have a net loss, then we need a credit to close it. Right? So make sure that you use this T account. It'll help you see exactly what you need to do for your third entry. And then finally, we need to take care of the dividends piece. We're going to close dividends. In this case, the dividends for this company were 40,000. And dividends is a debit balance account, so we need to credit it to get rid of it. And because now we're calculating retained earnings, it is going to debit retained earnings for 40,000. Now, because retained earnings is an equity account, a credit to retained earnings does increase it, but a debit to retained earnings will reduce it. So that is exactly what these two entries are doing. They're calculating my retained earnings for me. The final piece of this, to really complete this formula, is to think about the retained earnings T account. So for our business in this example, they had retained earnings of $455,000 at the end of the period. And retained earnings is never touched until we get to closing entries. So this would have been its unadjusted balance, its adjusted balance, but now it's going to have a different post-closing balance because I'm crediting retained earnings by 105,800. This is my net income being credited, and I'm debiting retained earnings by 40,000. This is, of course, my dividends. And now I can see where retained earnings ends up when the dust settles on that. So we take the 455 beginning retained earnings, add the net income, and then subtract the dividends. That gives me 520,800. So this would be my ending retained earnings. This is what would appear on a 12/31/20 balance sheet. So this is the one account that really gets updated. I shouldn't say that because I mean, all of our expenses and revenues are getting updated. They're just getting updated to be zero. Our income summary is created and closed during the closing process, and all in service to getting this retained earnings to its most current balance, its ending balance at December 31st, 2020. And that's the closing process.